Welcome, my name is Rob Edwards and I'm one of our team of experienced financial planners at Moore Kingston Smith Financial Advisors. Firstly, may I start with thanking you for taking the time to view our short webinar today on pensions and furlough, which will run for approximately 10 minutes. The government has introduced several packages to help businesses through the current economic difficulties created by the coronavirus pandemic. Of particular interest are the Coronavirus Job Retention Scheme, which provides help for employers, and the Self-Employed Income Support Scheme, which provides help for the self-employed. In this webinar, we will look at these two schemes, what these two schemes mean for the pension savings of both employees and the self-employed. This presentation is based on our current understanding as guidance from the government and is being updated on a regular basis. Let's look at some of the basics of the Job Retention Scheme as it stands. It's generally well known that eligible employees must receive at least 80% of their regular monthly income, capped at £2,500. In addition, employers may choose to pay their employees their full wage, but will not receive any government help for amounts over the minimums. An employee's pension earnings for a job that has been furloughed will include the amount that the employer actually pays them during furlough. This could mean a significant reduction for some, so care will be needed when topping up pensionable earnings late in the year. It is a condition of the scheme that 80% of the salary must be paid. If, however, a salary is to be reduced, this may mean changes to their employment contract by agreement. This should be done in a way that is consistent with employment law. With regards to the pension savings under auto-enrolment pension schemes, employers should continue to honour the full amount agreed under scheme rules unless permitted changes are made. Again, this means employers may have to fund any excess over the job retention scheme. Employers can claim a grant in respect of each furloughed employee towards the cost of keeping them on the payroll. This will be equal to the lower of 80% of the employee's regular wage and £2,500. In addition, they can claim for employers' national insurance on the amount, plus the employer pension contributions up to 3% on qualifying earnings under the auto-enrolment standard quality test. For the purposes of the claim, the regular wage includes any payments the employer must make, such as past overtime and compulsory commission. It excludes discretionary bonuses and benefits in kind. However, it also excludes any benefits provided through salary sacrifice arrangements, such as salary given up in exchange for an employer pension contribution. An employer pension amount above £59.40 must therefore be funded by the employer as per their contract of employment. This may be the case, for example, if the scheme is set up of one of three alternatives to the standard quality test, or the employer chooses to pay employees a full wage. Similarly, any agreement to pay an increased employer contribution under salary sacrifice must also be honoured. The grant received by a business will be included in taxable profits for income and corporation tax, but as the payments made to employees under the scheme will be deductible, including payments into pensions and employer national insurance, the grant should not increase the tax liability for the business. The example in this slide shows how this would work in practice, resulting in a total grant claimable of £2,803 for an employee with a gross salary of £2,500. With regards to employer duties and furlough, no changes need to be made to existing schemes under the Coronavirus Job Retention Scheme. An employer's automatic enrolment duties must continue as normal for both furloughed staff and those who are still working, including re-enrolment and compliance duties. However, with regard to re-enrolment, employers are allowed 3 months beyond the third anniversary to assess their staff. In this slide, we will consider if employers can reduce or stop contributions. Employees may also wish to reduce their contributions or even stop them altogether during these financially difficult times. The pensions regulator is very clear, however, that employers should not induce or persuade employees to do this. Contributions can be stopped by opting out of the scheme. Similarly, employees reducing contributions below auto-enrolment statutory minimums will also be treated as having opted out. The consequences of this could include losing out on, firstly, valuable employer contributions. Secondly, tax incentives offered to pension savers by HMRC. Thirdly, future investment growth. And most importantly, the chance to rejoin the scheme once the job retention scheme has come to an end. They can also ask to be re-enrolled, but the employer is not obliged to do so within 12 months of them opting out. Moving on now to employer contributions. With regards to employer duties and furlough, no changes need to be made to existing schemes under the job retention scheme. An employer's automatic enrolment duties must continue as normal for both furloughed staff and those who are still working, including re-enrolment and compliance duties. However, with regard to re-enrolment, employers are allowed 3 months beyond the third anniversary to assess staff. Employers are allowed to reduce their contributions under auto-enrolment rules, but not below the statutory minimum of 3% of qualifying earnings, otherwise known as a standard quality test. If the employer has more than 50 employees, it must consult with employees before implementing any reduction. The minimum period for consultation under normal circumstances is 60 days, but the pensions regulator has stated that during these difficult times, it will not take action against employers if the period is shortened, providing certain conditions are met. However, there are other things employers should consider before reducing contributions, whether or not there is a requirement to consult. These include: does the change constitute a breach of the employment contract? In this case, legal advice may be advised. Does it break any agreements reached with trade unions or staff representative bodies? And lastly, do the scheme rules allow a change? In this slide, we will consider if employers can reduce or stop contributions. Employees may also wish to reduce their contributions or even stop them altogether during these financial challenging times. The pensions regulator is very clear, however, that employers should not induce or persuade employees to do this. Contributions can be stopped by opting out of the scheme. Similarly, employees reducing contributions below auto-enrolment statutory minimums will also be treated as having opted out. The consequence of this could include losing out on, firstly, valuable employer contributions, secondly, tax incentives offered to pension savers by HMRC, thirdly, future investment growth, and lastly, the chance to rejoin the scheme once the job retention scheme has come to an end. They can also ask to be re-enrolled, but the employer is not obliged to do so within 12 months of them opting out. Let's consider salary sacrifice. Some employees may also consider cancelling salary sacrifice arrangement they have entered into with employers, perhaps thinking this would increase the income during these difficult times. HMRC have said that this is possible as the current situation is regarded as a life event, allowing such arrangements to be cancelled. By doing this, and on the assumption that the employer is able to pay the higher salary, the employee would then be faced with funding the contribution required under the scheme themselves. Consequently, they would be no better off immediately. However, if the employee chose not to make the contribution, they would effectively be opting out of the scheme and therefore lose any associated benefits. If salary sacrifice arrangements are left in place, employers still have to pay the sacrifice salary as an employer contribution. Finally, if an employer is not able to pay the pension contribution under salary sacrifice, or they are not able to pay the full pre-sacrifice higher salary if the agreement is cancelled, this may mean changes to the employee's employment contract by agreement. Again, this should be done in a way that is consistent with employment law. What about the self-employed? The scheme to support the self-employed is similar to the job retention scheme for employees. Broadly speaking, provided the business is eligible, individuals can claim a grant for the lower of 80% of their earnings of their average monthly trading profits over the last 3 years, or £2,500. The average may be over a shorter period if they have not been traded for the last 3 years. The grant received will form part of an individual's taxable income and will therefore count towards pensionable income. Unlike employees, there will be no direct help towards any pension savings for the self-employed, although the business will still be able to claim for wages and pension costs for employees on payroll through the job retention scheme. So, to summarise my webinar today, as an employer, consider how your pension scheme is affected by the job retention scheme and any actions you should take. As an employee, consider how you will be affected by being furloughed under the job retention scheme and ensure you're making the most of any pension contributions. Lastly, if you would like any professional advice on pensions and furlough, or have any other pensions or wealth management question, please get in touch. Thank you for your time today.